Here are my top 8 stocks to buy right now, half of which I currently own and half of which I'm currently considering adding to my portfolio. We'll alternate going over one stock that I own, followed by one stock that I'm still researching, and work our way up until at the end, I show you the exact stocks that I've bought and sold in the past 30 days. And I'll show you a pie chart showing my exact stock positions that I'm investing in. By the end of this video, you might learn something new about a stock that you already own, or you might find some new great investments that you haven't thought of looking into before. So let's start by going over my actual stock performance this year so that you can see I'm not just making this stuff up. So here is my actual Charles Schwab portfolio where I invest the majority of my individual stocks. You can see that over the past 6 months, it's up around 20% overall. Now, you gotta be a little bit careful because Charles Schwab counts adding new money to the portfolio as a gain, which doesn't really make sense, so the actual gain's a little bit lower. But if we look at this over a shorter time horizon, in just the last month, I've made around $6,000 in this portfolio. And you can also see how investing in these individual stocks can be very volatile, with big swings downward and then back up and then back down again. And that's kind of the name of the game when you're investing in hyper-growth tech stocks like I tend to invest in. I also keep a big chunk of money in just regular index funds, which helps balance out some of that risk. But now let's start getting into my individual stock portfolio, starting with a stock that I've never talked about before on this channel. ARM. Now, ARM stock might be a bit of a controversial choice. The stock only IPO'd recently and they are down over 16% from their overall peak. Analysts of the stock seem to be a little bit split on its valuation, with some saying that the valuation is fair, but that there's little upside from here. This isn't surprising because we've seen several tech IPOs over the past few years where the stock price spikes up immediately and then sells off over time before in the long term kind of settling down to where the long-term valuation is. So in the short term, we could see a ton of volatility in this stock before the market kind of figures out how the stock should be valued. Now, ARM actually used to be a public company back in 2016, and at one point, Nvidia was considering acquiring the company before that acquisition was called off due to regulatory pressure. And now SoftBank, one of the largest investing banks in the world, has announced that they would take ARM public instead, with the stock price gaining nearly 25% after they first went public. Now, ARM, for anyone who doesn't know, is a chip maker. Their chips run in everything from cell phones to VR headsets to some laptops. And for a while there, they completely dominated the mobile computing market, with their ARM architecture being much faster on these smaller devices that can't suck up a ton of energy versus other chip makers like Intel or Nvidia. More recently, ARM has come under some pressure as Apple has switched away from using ARM in all of their devices to starting making their own M1 and M2 chips. But for companies who don't have Apple's sort of scale, ARM is still pretty much the name of the game for mobile computing. Even massive companies like Google and Facebook still use their processors. As we see continued interest in more mobile computing as the laptop and desktop market continues to decline and mobile phone and tablet usage increases, ARM may see continued growth in its total addressable market. And if we see more VR and AR headsets pop up, that would also be a benefit for the company. Not to mention the fact that we've seen companies like Nvidia, who is another major chip maker who's really gotten in on the crypto and AI trends of the last couple years, has seen their stock price rise a ridiculous 560% over the past year to now sitting at a market cap of $1 trillion. If ARM can see even a fraction of the increase in price that Nvidia saw, they could have a massive runway ahead of them from their current $56 billion market cap, which is what, 1/20th the size of Nvidia today, especially considering they serve very similar markets. But at the same time, this is a very risky stock. There's still a new IPO, and there's no guarantee that they won't get outcompeted by the Apples, the Nvidias, and the Intels of the world, which is why I'm still looking into this stock. And make sure to stick around until the end of this video where I'll be going over all the stocks that I did buy in the past month, as well as a few major stocks that I sold. And you might be surprised by some of the companies on that list. I posted dedicated videos on SentinelOne and Crowdstrike a few weeks back on StockPick, the sponsor of this video. StockPick is the all-in-one app for learning about investing through bite-sized video content. StockPick provides short videos on the latest financial news, stock ideas, and market updates. And unlike social media, it's all curated by experienced journalists, analysts, and investors. I've been posting 3 videos a week to StockPick, and if you sign up today, you can get free access to watch those and any future videos that I post to the app, along with tons of other content from analysts and other creators. And you can sign up completely for free by clicking the link in the description below. StockPick videos are great for anyone who doesn't have a ton of time to get their investing news fix. They have videos on daily stock tips and valuable trade ideas for your portfolio. If you're into crypto, they have investors who cover that. They have educational videos to grow your investing knowledge with basic investing concepts and strategies from real investors. One of the features that I like most about StockPick is their StockPick News. It's like a whole TV news segment shrunk down into 2 minutes, where you get all your essential market news curated by real financial news experts. You get real-time updates multiple times a day, and you get engaging content that's well put together and fun to watch while being informative. So check out StockPick using the link below. It's totally free, and it'll save you a ton of time by only providing you with information from vetted creators and real stock analysts. But next up, let's talk about two companies in one of the fastest growing industries in the world that are competing to create the future of security. Crowdstrike and SentinelOne are two AI-powered security companies. They have realized that you can no longer use traditional security methods to protect cloud workloads. Nowadays, more and more companies are moving their applications into the cloud, and with that move, they're looking for cloud-native security providers. Companies like Crowdstrike and SentinelOne were built from the ground up on the cloud, and so they are especially well equipped to deal with this new market phenomenon. And they are both heavily incorporating AI into their products. In a traditional security model, you would look at all the different threats and hacks that had happened and put that into a giant database. Then when a new potential threat comes in, you can compare that with your database and see if it looks similar to previous attacks. The problem is, if you have a novel attack that no one's seen before, it might get through your filter. But with AI, you can create pattern recognition across all previous attacks and proactively detect potential threats before they impact anyone. And with more and more growth in attackers from technologies like generative AI, making it possible to completely automate the writing of viruses, these kinds of companies are becoming even more important. But while security is important, that doesn't mean every security company is created equally. CrowdStrike is a much larger company than SentinelOne, and so historically they've been growing a lot slower, but they've been more profitable, while SentinelOne has been the super fast growing but smaller, more volatile stock. But that seems to be changing. CrowdStrike in their most recent quarter has reported that they are now GAAP profitable for the second quarter in a row, and they are growing their annual recurring revenue at 37% year over year, reaching $2.93 billion total dollars in annual recurring revenue. Now let's compare that to SentinelOne. SentinelOne is also growing very quickly. In fact, they're growing faster than CrowdStrike. Their annual recurring revenue was up 47% year over year, so 10% higher than CrowdStrike. The only thing is, their annual recurring revenue is around 1/5 the size of CrowdStrike's at just over $600 million per year. So even though they're growing a little bit faster, they are a way smaller company and they're not yet profitable. Add on top of that the fact that SentinelOne is currently burning through cash with a negative free cash flow margin, meaning that as we enter a potential recession and companies cut back on spending, SentinelOne has to burn through their cash stores just to try to survive. Versus CrowdStrike, which is a cash cow that generated $244.8 million from operations in the last quarter. But that's not even the worst comparison for SentinelOne. Remember, SentinelOne is currently growing 44% with $612 million in annual recurring revenue. But since CrowdStrike is a very similar company to SentinelOne, we can just go back in time to look at when CrowdStrike's numbers looked similar to SentinelOne's. Back in March 19th of 2020, CrowdStrike had annual recurring revenue of $600 million, pretty similar to where SentinelOne is today. Only while SentinelOne is growing 47%, CrowdStrike was growing at 92% year over year back then, which is just a completely different ballpark. Now, this isn't because SentinelOne is bad at running their company, but the fact is CrowdStrike hit that perfect timing right after lockdown started, where cloud in general was just absolutely exploding, and so they were able to ride that wave to growing even faster. Meanwhile, SentinelOne is just hitting their stride amid a major economic recession, and so they're not able to compete at the same level CrowdStrike was, which is one of the reasons that I own 100 shares of CrowdStrike at a market valuation of just under $17,000, and that's off a cost basis of $13,500. So this stock has made me a profit. And Charles Schwab rates this stock as a D, but to be fair, I think Charles Schwab is more of a valuation-focused metric than a growth metric. At one point, CrowdStrike was rated as an F for 3 years, and I rode the stock up 300% during that time before selling out. So personally, I don't really pay a ton of attention to those kinds of ratings, unless I'm trying to find a value stock. And now, let's talk about a stock that's grown into my single largest holding outside of my retirement account. And that stock is SoFi. SoFi is a fintech company, but they stand out in the fintech market market compared to their competitors. And it's really clear to see this in their stock price. Why is it that SoFi's stock price is up 92% year to date, while other finance companies like Wells Fargo have seen their stock price be basically flat for the year, or other companies like Bank of America have seen their stock price drop by almost 15% for the year? Well, SoFi isn't just a finance company. You can watch my previous videos on SoFi where I get into them in more detail, but this is a company that's benefiting from three major trends. The first is an aging user base, the second is an improving macroeconomic environment, and the third is a growing demand for fintech technologies. Starting with the first trend, SoFi is targeted toward younger users. Their goal is to find millennials and Gen Z who make a lot of money. Their average lending customer makes well over 6 figures and has basically an 800 credit score. They want to acquire these customers early, get them onto all of their products, treat them really well, and then grow as those customers make more and more money as they age. So they might start out by offering a student loan to a student in an engineering degree. Then as they get older, they might offer them personal loans and then mortgages and maybe eventually retirement accounts. So as SoFi's user base ages, SoFi just naturally grows as they make more and more money. Trend number 2 is an improving macroeconomic environment. SoFi, before the pause in student loans, owned around 80% of the student loan market along with 2 other companies. But that business completely collapsed once the student loan pause was enacted. And so SoFi had to shift. They had that huge hole dug out of their business and they filled in the hole with personal loans and mortgages and even auto loans. But now we're seeing a shift back towards student loan borrowing, which kicks up again in October. And at that point, once student loans begin, they're going to see refinancing loans that will add back up onto that pile that had previously been dug out, which means SoFi's growth rate may increase even from where it is today, where the company's revenue is already growing at nearly 40% year over year off of nearly $500 million in revenue per quarter. And that's not to mention the fact that high rates, which we're seeing right now with the Fed raising rates to combat inflation, tends to benefit companies that make a lot of loans, like SoFi. And then number 3, we're seeing growing demand for fintech technologies. Whether it's digitization, the proliferation of data, AI technology trends, all of these trends that are occurring in tech are going to start impacting the banking industries, and companies that are able to use these technologies effectively are going to win out. Now, not every bank needs to become a technology company, but SoFi plans to build the AWS of fintech, basically a fintech platform that other banks can build on top of. They're already seeing success with this, with competitors like Robinhood using their Galileo technology platform. And as more and more banks realize the need for these fintech technologies, SoFi's business is only going to continue to grow, which is why SoFi has grown to become one of my largest stock positions overall. I own 1,900 shares in the company at a value of $16,500, and that's up around $4,500 off of my initial investment of $12,000. And of course, Charles Schwab has rated this an F the entire time. But now let's get to another stock that I don't own, but I really wish I had bought when I talked about it earlier in May of this year. And that stock is Meta, aka Facebook. If I asked you what has Meta's stock price done in the past year since they announced their switch over into metaverse technologies? I mean, they're not really in the news anymore. The hype for metaverse has kind of died down. We've seen new competitors start to crop up, like the Apple Vision Pro. So you might think that their stock price is flat or even a little down for the year. But when I checked in the preparation for this video, I was shocked to see that their stock price is up 144.8% year to date. It looks like basically a straight line up from January until now. And because Meta is such a large company, that's $450 billion in new value they've created just this year. Now, when it comes to these large cap companies, I take a slightly different approach with investing in them. I think it's a little harder to find opportunities where companies are undervalued because so many analysts are already looking at these stocks. And so just looking at their earnings and their profitability, those have all been analyzed to death. So instead, what I tend to look at is there some sort of fear affecting the company or irrational hype? So we can check, is Meta currently in a state of mostly fear from investors, or is it overly hyped up? Well, it seems like most people seem to have taken a pretty negative view on Mark Zuckerberg's pivot over into the metaverse. Here's an article saying what Mark Zuckerberg got wrong about the metaverse. Here's another one talking about how Mark Zuckerberg's mistakes is the reason Meta had so many job cuts. Here's one saying that Zuckerberg's metaverse was a colossal failure. So overall, I would say overall sentiment is still pretty negative about the company, which in my mind means there could be an opportunity to invest here if you actually think that their long-term goal is reasonable. And to be honest, I still think Meta is better positioned than any other company, even Apple, to take advantage of the new pivot into AR and VR technologies. Apple is going to make a fantastic product, but they're never going to be in that area quite as aggressively as the front runners like Meta. And so if they're able to innovate and kind of grow from where they are today with their very cartoony graphics, this could become a very important company in the future. Now, you might say, okay, sure, Meta's stock price is up a lot in the last year, but that's only because the stock price dropped so much from 2021 through 2022, and then it's just recovered from then. So that's clearly a sign that Meta really made a mistake by switching into the metaverse. But if we look at other technology stocks over that same time period, we see basically the same trend. Here's Amazon, who saw a similar drop from 2021, and they just haven't recovered as much as Meta. Or here's Google, who also dropped from 2021 through 2022 before slightly recovering. So it's clear to me that Meta's stock price got pushed down a little bit too far after people kind of jumped off the Meta bandwagon, and so there could still be an opportunity to make some upside in this stock. But now let's switch over to my third largest stock position overall, and one that I've talked about a ton on this channel, and that stock is Datadog. I currently own 146 shares of Datadog at a value of $13.7 thousand, and this one is actually down off my initial investment of $19,000, so it's lost around $5,000 overall. And while you might say I should have jumped out of the stock earlier this year, if we look at the stock price over the past 6 months, it's up around 40% over the past 6 months. And the reason the stock price is down is because it hasn't fully recovered from that massive drop it saw from September 2021 through the beginning of 2023. Now, Datadog is a data company. Their goal is to unite a company's applications, their infrastructure, and their security all through what they call a single pane of glass. Basically, their belief is if you can get all that data into one place, you can make better business decisions. And when we're in a world with cloud technologies, IoT devices, generative AI, gathering data is no longer the hard part. The hard part is condensing that data down into insights that can actually help you grow the business, which is why British mathematician Clive Humby in 2006 said that data is the new oil. You can't just pull it out of the ground, you have to refine it and turn it into something useful. And Datadog is better at that than almost anyone else. The company is currently making over $500 million in revenue per quarter while growing at 25% year over year. And at the same time, they are cash flow positive. Now, some critics of the stock may point out that the stock is not yet GAAP profitable, but I would argue that the cash flow positive is more important in this case. Profitability is kind of just an accounting term. It doesn't actually mean that much in the physical world, because it's actually possible to be profitable and still have your company go bankrupt if you run out of cash. On the flip side, if your company is not profitable, but it produces positive cash every quarter, your company is never going to run out of money. It's almost like if you buy a house and you're putting a ton of money into the house and the house is going up in value, but you have no cash left over. Yes, you're technically making a profit, your net worth is increasing, but if you have no cash to maneuver with, you feel really poor. And companies that have cash, especially during an economic downturn like we're seeing right now, tend to see that cash is king. With cash, they can buy back a dropping stock price, they can reinvest in building new products, or they can even acquire competitors that are struggling during the downturn. And so even though Datadog's growth rate has declined substantially from where they were back in 2020, the company is still positioned well in my mind to continue to capture more of the data space and continue to grow. But now we're going to switch over to the last new stock that I don't currently own before getting to my final stock in my portfolio. Next up, we have The Trade Desk, which is an ad tech company. When you think ads online, you probably think of Google or Facebook. They basically own the lion's share of the ad market. But The Trade Desk basically fills in all the rest of the gaps. The Trade Desk on their website describes themselves as a media buying platform built for the open internet. They make it so you can unite your ad data across a whole bunch of different platforms, whether it's a TV or an internet website or a mobile app. And what's especially exciting about The Trade Desk is they are growing faster than the overall ad market, despite the massive competition from companies like Google and Facebook or Meta. And because the internet market is growing so quickly, that is a very high rate of growth. From the year 2000 through 2023, the usage of the internet increased by 1,300%. And with Asia now accounting for the majority of internet users, we're seeing that number continue to grow as more and more new people start to join the internet and spend money on it as well. You're seeing e-commerce companies pop up in Brazil, in Mexico, in India, and those e-commerce companies are going to be spending even more advertising dollars on online platforms. Sure, some of that's going to Google, some of it's going to Meta, but everything else could go to The Trade Desk, which is clear when we look at their international growth, which is actually outpacing their US revenue for the second consecutive quarter. And if you want to invest in this growing base of advertising revenue and new people moving onto the internet, you can invest in Google but it's going to be pretty diluted because Google's such a big company and they have so many products. You could invest in Meta, but obviously their ads business isn't the whole company. They have their whole VR section that I already talked about. And so the trade desk is a small, profitable, and very focused trade you can make to invest directly in ad technology. And so that's why it's a company that I'm considering investing in. Which leads us now to the last stock in my personal stock portfolio, Cloudflare. Cloudflare is a company that's trying to make the internet itself work better. They started by just hosting other people's websites and building firewalls to protect those websites. But then they realized if they're already analyzing all the traffic for bad actors coming in, why not also try to optimize the web experience for good actors? And from there, they were off to the races, becoming one of the most innovative companies on the planet and launching product after product after product that would make the internet work better. Remember, the internet is basically 1960s through 1980s technology that we're just kind of building on top of over time. Cloudflare is trying to bring that into the 21st century and make the internet run in a way that actually works in our new cloud interconnected environment. I already talked in my previous video about Cloudflare's earnings. They're making $300 million in revenue, up 31% year over year. And while they're not yet profitable, they are starting to focus more on improving their margins and approaching profitability. But what's interesting for this video is Cloudflare's institutional ownership, basically giant investors that are investing in the stock. We're seeing analysts from the large banks like KeyCorp increasing their price target on the stock. Same for companies like Wells Fargo increasing their price targets. Now, normally I don't really pay any attention to what the analysts recommend. It's usually just total garbage that they put out. But it is interesting that these large banks are taking an interest in Cloudflare, especially when they've been shunning growth stocks in the last couple years. In fact, now there's a total of just 7 investors who own the majority of the company, with 52% of the company being owned by these large institutions. So there are clearly some very wealthy investors making some very big bets on this stock. Now, there is some risk to the stock price because if even just one of them sells, that could be enough to temporarily bring down the stock price. But for long-term investors like me, it's less of an issue because in the long term, I expect the stock price to reflect their underlying value. And it's reassuring that there are some large institutional investors who see value in this company. And now moving on to the bonus stock, stock number 9, which is Bank of America. Now, Bank of America is interesting because it's actually not a stock that I would invest in, but I want to walk through how I go about deciding not to pick a stock so that you can hopefully learn something about that you might incorporate into your process. There are a couple reasons that I wouldn't invest in Bank of America. First of all, we're currently seeing very high interest rates, with the Fed even considering raising rates even higher if inflation doesn't decrease. In general, lenders, aka banks, tend to benefit when rates are higher because they can make more money on the short-term loans that they offer to customers. But according to most sources, the Fed is unlikely to raise rates in November as they're starting to see inflation stabilize and even drop slightly. So that's going to be a negative for the large banks. At the same time, high inflation tends to hurt banks because they tend to be net creditors, which means that if we look at a long-term chart of inflation over time, even though the inflation rate has dropped from the insane 9% we saw back in June 2022, the still elevated inflation that we're seeing over most of the past several decades is something that is hurting the banks more than benefiting them. And then on top of that, we see a lot of physical branches of banks, including Bank of America's branches, starting to close in 2023. They've seen a large drop in foot traffic over the past years, and so companies have been cutting back on the number of physical branches that they need to keep on running. Now, normally this could be a good thing. It might make the company more efficient and mean they run better. But in Bank of America's case, that doesn't seem to be the case, where we've seen the stock price drop throughout the last year, despite the fact that they're cutting back on these stores, meaning they're doing it to save costs rather than to make the business more efficient. And as we see more and more of the finance industry shift toward more fintech disruptors, companies like SoFi are going to be grabbing more of the mind share of younger bankers, while Bank of America's demographic of people who want to go into physical branches starts to age out of the banking system. Between online banking and e-signature services, I haven't need to go into a physical bank basically ever in my life, and that includes when I actually bought my home. It could all be done digitally. And so while Bank of America may eventually pivot over into more digital services, as of right now, they are massively lagging not just the fintech disruptors, but even other companies in the market like JP Morgan or Wells Fargo, who have been launching products that appeal more toward younger demographics with the hope of getting them into their ecosystem before they kind of lock into some company like SoFi and then age up and start making more and more money. Now, I did say that at the end of this video, I would show you every stock that I own and any trades that I made in the past month. So I'll put my total stock portfolio on screen now. And if you were in my Circle stock group, you've already seen the trades that I made, but just to recap here, I sold all of my position in SentinelOne, probably not a surprise, bought more Crowdstrike, sold around 1/3 of my Snowflake shares, and sold 50% of my build Circle.com position. And I'll talk about why I did that in future videos, and I've already posted about it in my Circle stock group. So make sure to like and subscribe. We're really close to hitting our goal of 50,000 subscribers before the end of the year, and I'll see you next time.